The committee will come to order. The committee today will examine the economic exposure of federal credit programs. I'd like to thank our witnesses for being here. We'll be introducing them shortly. And as I begin, I want to thank Senator Mike Lee for agreeing to spearhead this program. He helped with us in terms of putting all this together and inviting the witnesses. He'll be here very, very shortly. I have a conflict and have to be on the Senate floor. And I apologize to the witnesses and my committee members here that I have to do this, but I'll put it in the capable hands of Senator Lee to conduct this hearing. He has played a leading role in raising attention to this issue. As I've indicated, he and his staff have helped us in putting together the hearing, including identifying some of our witnesses. Today, we will examine why accounting for our federal assets matter and why inaccurate monitoring can bring economic harm to both borrowers who pay higher interest rates to cover the defaults of others, private lenders who are frozen out of markets they seek to serve, and taxpayers who may be exposed to unqualified losses. During my prior service in the Senate, I was one of the nay votes for the Omnibus Budget Reconciliation Act of 1990. 25 years later, I never imagined that I would be chairing a hearing to debate the impact of accounting rules passed back then. This situation reminds me of an old Yogi Berra quote, "The future ain't what it used to be." The 1990 reconciliation law included the Federal Credit Reform Act, accounting rules crafted in reaction to the rocky credit history of the 1980s. The Resolution Trust Corporation held the assets of failed savings and loans and put the federal government in the loan workout business. Sadly, fraudulent student loans made during that decade led to a 20% student loan default rate and a loss equal to almost 10% of outstanding loans. Cash accounting for all these asset changes within a budget year presented a volatile picture of the federal budget that properly represented spending trends. Since then, the federal government has followed the rules of FCRA, recording an annual present value adjusted, quote, subsidy cost to account for losses it may incur in the future charged against loans it has made directly, as well as guarantees it provided for loans made by others. It took 10 years to refine the complicated net present value calculations used for FCRA, but by 2002, government accountants calculated that the federal portfolio of $1.3 to $1.4 trillion in loans and guarantees generated annual subsidy costs in the range of $5 to $12 billion. Now, this brings us to the financial crisis of 2008, which ballooned the government's loan assets. FCRA's accounting rules converted loan subsidy cost into deficit reducers. Since 2008, government accountants have booked nearly $200 billion in annual subsidy gains, while the amount of federal loans and guarantees has more than doubled. As a result, it is clear that the more credit market exposure the government takes on, the more that expectations of future revenue rise under the current accounting rules without equal accounting for higher risk. At the end of September 2014, loans made or fully guaranteed by the federal government totaled over $2.9 trillion. This includes $1.1 trillion in student loans. Additionally, the Federal Reserve reported that non-mortgage consumer debt totaled $3.3 trillion as of September 30, 2014, giving the federal government a 1/3 share of the U.S. consumer loan market. Add that to the 70% of the mortgage market that the federal government holds through direct loans guarantees and Fannie Mae and Freddie Mac, and the federal government is the largest consumer lender in the country. A lot has changed in those 25 years. So today we must ask ourselves, do accounting rules passed 25 years ago reflect the complexity of today's financial world? I'd now like to recognize Ranking Member Maloney for her opening statement. And just before I do, I want to hand over this gavel. When I first got a gavel in my hand, I thought, wow, I can get something done here. So Mike, be careful. Don't take us past the jurisdiction of the committee. It would be tempting, but I'm putting this in very capable hands, and thank you for heading up this hearing. But first, let's hear from Congressman Woman Maloney, and then after you give your opening statement, I would ask you to introduce the witnesses and take care of the hearing. Thank you. Right.
Thank you so much. Thank you so much, Chairman Coates, for holding this, and I thank all of our panelists for being here today. In this morning's hearing, we will compare two systems for budgeting federal credit programs. The first, the Federal Credit Reform Act of 1990, so-called FCRA, was signed into law by George H.W. Bush in 1990. It has proven a reliable tool for budgeting federal credit programs. The second, so-called fair value accounting, is a program supported by some of my colleagues in the Republican Party that will make federal credit programs seem more expensive. If implemented, this system will necessitate cutting loan programs or raising interest costs. In my mind, there is nothing fair about the fair value accounting. At its root, today's hearing is about two vastly different philosophical approaches to government. My Republican friends believe that the federal government, in this case, federal lending programs, should operate just like the private sector. But the federal government is not the private sector. The principal motivation of the private sector is to maximize profit. The principal goal of government is to provide services that the private sector cannot or will not provide. These differences are especially clear in federal lending programs. Private institutions make loans that they think will be the most profitable, but the United States government sees things differently. For example, it lends to a group of individuals with little or no income and no credit history. They are known as college students, and there are more than 20 million of them in the United States today. The vast majority of student loans are issued by guaranteed by the federal government. Why does the government take on this risk? Because it helps millions of Americans go to college who might otherwise not be able to afford to go. It also benefits the rest of us by creating a more educated workforce. A better workforce will make our country more competitive and will make our economy stronger and our country stronger. This is a social good not recognized by private lenders. I want to turn to the specific question of how we measure the cost of federal government loan programs, how these programs are accounted for, and how their budget impact is assessed will affect the broader deficit outlook and choices we make as policymakers. The current procedure under the Federal Credit Reform Act appropriately calculates the lifetime costs of federal credit programs, reflecting both the risk of default and the government's cost of borrowing. FCRA has been very accurate. OMB found that since in the more than 20 years that FCRA has been in place, the initial cost estimates of all credit programs differed from their actual costs by less than 1%. As they say, if it ain't broke, don't fix it. But today we're apparently trying to fix a system that already works very well. It's part of a broader ideological initiative. In tax policy, Republicans are trying to change the rules of the game by instituting so-called dynamic scoring. This would make tax cuts seem less expensive than they really are. In federal credit policy, Republicans are trying to change the rules of the game using an accounting system that will make programs like student loans look more expensive. The result of this so-called fair value accounting will be cuts in federal loan programs. For example, less money available for students at higher interest rates. Under fair value accounting, the cost of federal credit programs, which are funded by the purchase of low-interest Treasury securities, would be evaluated as if these governments were forced to borrow with an additional risk premium demanded by the private sector. As the Center on Budget and Policy Priorities put it, fair value budgeting requires that the budget, quote, reflect amounts that the Treasury would never actually pay anyone, end quote. It will make federal lending programs appear more costly than they really are. Millions of Americans have something to lose if proponents of this accounting system have their way. I regret that we don't have any of their representatives on the panel today. However, Chairman Coates and I have received letters from a number of organizations that strongly oppose the fair value accounting system. I have a stack of them here. And I have a letter with me right now from the National Education Association, which states, and I quote, NEA opposes the use of fair value accounting in federal credit programs, especially student loan programs, because it would artificially raise their costs and make them appear to be more expensive to the federal government than they really are, end quote. I ask unanimous consent to place this letter into the record.
Without objection.
A letter from the National Association of Home Builders states, and I quote, fair value accounting would artificially raise the rates on home loans. And I would also like to enter that letter into the record. Other noted organizations also oppose using fair value accounting for budgeting purposes. The National Association of Realtors, the National Association of Independent Colleges and Universities, the Retired Enlisted Association, the National Rural Electric Cooperative Association, the Student Aid Alliance, the National Multifamily Housing Council, and many, many others. And I would like to place these letters that I just mentioned into the record. In conclusion, I ask that we listen to both sides of the debate today, but that ultimately we not let ideology trump reality. Fair value budgeting would distort the budget process, undercut federal credit programs, and ultimately deprive millions of Americans of the financial support that they need to get an education, buy a home, or start or operate a small business. I look forward to our discussion today, and I thank each of the witnesses for appearing before the committee. And I yield back. Thank you.
Thank you, Representative Maloney. And the documents you've submitted will be submitted into the record without objection. I want to thank Chairman Coates for calling this hearing, and also for his insightful remarks and for the remarks that we've heard so far from Representative Maloney. From the early days of our republic, we have had an ongoing debate about the role to be played by the federal government within the credit market. The provision of credit to the states and its assumption by the newly formed federal government was a topic of great debate and discussion during the drafting of the Constitution in 1787 and during the early Congresses formed pursuant to that document. Provision of credit by the federal government has a somewhat more recent history. As Mr. Elliott, who's one of our witnesses today, noted in his book, Uncle Sam in Pinstripes, the provision of federal credit began in the way we're discussing today in the early part of the 20th century. It began with farm programs under President Theodore Roosevelt. These programs have ballooned over the past century. Today, we frequently hear about $18 trillion in total outstanding public debt. It's far less common to hear about the $3 trillion in federal government loan exposure that journalist Michael Grunwald identified earlier this year. This federal credit system has grown over the years, at times responding to perceived political needs and at other times responding to political pressure from special interests, natural mission creep, and bureaucratic ambitions. This has left us with a system that no one would design. We have a housing finance system that leans almost entirely on federal backstops in the FHA and VA. We have a student loan program administered almost entirely by the federal government, a program that notably took considerable write-downs over recent weeks. We have the Export-Import Bank that was founded before exporters could easily fly across the ocean to visit customers, and now exists largely to facilitate deals between large corporations and large banks while leaving the taxpayer on the hook. From TARP to farm programs, the federal credit system is hard to think of as a system at all. except for one feature. If things go wrong, the federal government is on the hook. If things go wrong, the taxpayer ends up with the bill. It's critically important that the Congress debate the wisdom of such a system's existence at all, including the constitutional and prudential justifications for the provision of federal credit. Today, we look to start that debate by discussing something much simpler than this larger discussion. Namely, we're looking to find valid means to analyze cost, compare management structures, and establish a general rubric to make apples-to-apples comparisons. We hope to be able to both compare different credit programs against each other and compare credit programs relative to spending, tax, or regulatory programs designed to accomplish similar goals. Getting on the same page on these questions will be a key step in the process of reforming these programs. So I thank the Chairman again for this opportunity. I look forward to the testimony that we're going to hear from each of our witnesses. And with that, I'd like to introduce our witnesses before we hear from them. We'll start on this end of the table and then move over. Dr. Douglas Holtz-Eakin is the president of the American Action Forum, and most recently was a commissioner on the Congressionally Chartered Financial Crisis Inquiry Commission. During 2001 to 2002, he was the chief economist of the President's Council of Economic Advisors. From 2003 to 2005, Dr. Holtz-Eakin was the sixth director of the Congressional Budget Office. From 2007 to 2008, he was Director of Domestic and Economic Policy for the John McCain presidential campaign. And following the 2008 election, Dr. Holtz-Eakin was the president of DHE Consulting. Dr. Holtz-Eakin received his BA from Denison University and his PhD from Princeton University. Jason Delisle is the director of the Federal Education Budget Project, which is part of the educational policy program at New America. Mr. Delisle is a leading expert on the federal student loan program and federal financing for higher education. Before joining New America in 2007, Mr. Delisle was a senior analyst on the Republican staff of the United States Senate Budget Committee. Prior to that position, he served as a legislative aide in the office of Representative Thomas Petrie. Mr. Delisle holds a master's degree in public policy from George Washington University and a bachelor's degree from Lawrence University in Appleton, Wisconsin. Douglas Elliott, a fellow in economic studies at the Brookings Institution, is a member of the Initiative on Business and Public Policy. A financial institutions investment banker for 2 decades, principally at J.P. Morgan, he was the founder and principal researcher for the Center on Federal Financial Institutions, a think tank devoted to the analysis of federal lending and insurance activities. He recently wrote the book, Uncle Sam in Pinstripes, Evaluating the U.S. Federal Credit Programs, the only comprehensive review of the federal government's credit activities to be written in the last quarter century. Mr. Elliott graduated from Harvard College, magna cum laude, with an A.B. in sociology in 1981, and in 1984 he graduated from Duke University with an M.A. in computer science. Last but not least, Paul Van de Water is a senior fellow at the Center on Budget and Policy Priorities, where he specializes in Medicare, Social Security, and health coverage issues. He's also director of the Center's Policy Futures Initiative. Previously, he was vice president for health policy at the National Academy of Social Insurance. Van de Water worked for over 18 years at the Congressional Budget Office. From 1994 to 1999, he was assistant director for budget analysis. So with that, why don't we hear from the witnesses? Let's hear from all of you. If you can try to keep your remarks within about 5 minutes, and then we'll proceed to questions from there. And we'll start with you, Dr. Holtz-Eakin.
Well, thank you, Senator Lee, Ranking Member Maloney, and members of the committee for the chance to be here today. Has been emphasized in your remarks and Chairman Coates' remarks before that, there's an enormous commitment of taxpayer resources to federal loans and loan guarantees. If you look at the tables put out most recently by the Office of Management and Budget, there are $3.3 trillion, this is 2014, in such loans and loan guarantees outstanding. And in light of the sort of magnitude of this commitment of resources, I applaud the committee for looking into this. I think it's an extremely important topic to understand. I'll be brief. I'll just make 3 basic points. Point number one is that the 1990 Federal Credit Reform Act was actually an enormous step forward in that it leveled the playing field between direct federal lending and the guarantee of private loans by the federal government. Both have the same economic function, they provide the same credit flow to the ultimate consumer, and they are both backed by the taxpayer and are a commitment of the taxpayer's resources. However, having said that, the Federal Credit Reform Act does have a glaring hole. If you look in the OMB tables, those $3.3 trillion in loans and loan guarantees are soon to make a profit of $22.3 billion, and not be perceived as a cost to the taxpayer. That's counter to anyone's intuition and reveals the flaw with the Federal Credit Reform Act, which is it omits an important source of risk, the market risk that are associated with credit activities. That omission of market risk causes FCRA to underestimate the true cost of credit evaluated in that fashion. And it is important when Congress is making decisions to not only have a firm handle on the benefits of credit programs, but also their actual cost to the taxpayers with all kinds of risks involved. The big difference between FCRA and fair value accounting is fair value accounting incorporates this market risk. It recognizes that as the economy fluctuates, there's a tendency for loan failures to bunch during downturns, and that risk should be involved in the calculation of potential losses in any credit activity. It also recognizes that the taxpayer has to come up with the money to cover those losses at a time when money is especially valuable. During downturns, Americans are less affluent, and they don't want to have to cover these losses. So fair value accounting gets that into the mix. The second reason it's pretty obvious that something needs to be done is it shouldn't be the case that if you take a loan in the private sector and simply drag it across the line between the private sector and government, it should somehow become more valuable or less risky instantaneously because of the label on it. And that's exactly what happens under FCRA. And indeed, we've seen examples of this in recent legislation where we have used a government takeover of a private loan portfolio to finance government activities. That's a pure budget gimmick, and one of the main reasons I think it's important to examine fair value accounting. The third point is that fair value accounting is not some untested theoretical proposition. When I was the director of the Congressional Budget Office, we undertook numerous studies of what important federal backstops would look like under fair value accounting. We looked at the Pension Benefit Guaranty Corporation. We looked at the student loan program. We looked at the then Chrysler bailout from the 80s. We looked at the guarantees for Air West during 2001, 2002. We looked at Fannie Mae and Freddie Mac. And in each case, you would see a clear pattern. Things that looked like they were profitable to the government became cost to the taxpayer. Things that were costly to the taxpayer were underestimated and needed to be revised upward. Since then, we've actually seen fair value accounting, both in resources given to the housing GSEs, Fannie Mae, Freddie Mac, and for accounting for the TARP program and in the budgeting of that intervention. So this is not something that's untested. This is not something that couldn't be done, and doing it would give a fair presentation of the commitment of taxpayer backstop to the credit programs, and I'd encourage the Congress to move forward with it. Thank you.
Mr. Delisle.
Thank you, Senator Lee, Ranking Member Maloney, and members of the committee. I'm glad to have the opportunity to testify about the costs of federal credit programs and the federal student loan program in particular. The federal government's direct loan program plays a vital role in our post-secondary education system and our national economy. It guarantees access to credit at favorable terms for millions of Americans who pursue credentials that range from short-term certificates to graduate and professional degrees. And despite the recent backlash against student debt, a government loan is a perfectly logical tool to support post-secondary education. Loans allow students to move some of the future earnings that they would gain from an education to the present to finance the education itself. Moreover, a robust private market for student lending is unlikely to develop because of information asymmetries and poor economies of scale. And a private market would likely make credit most readily available to those who need it least. It would also restrict credit availability in times of economic stress, the point at which demand for higher education surges. So while the case for a government student loan program is strong, so too is the case for knowing what it costs. One point helps make that clear. The student loan program is quickly set to become the largest government loan program. With $1.2 trillion in debt outstanding, it is on the verge of eclipsing mortgage guarantees made through the Federal Housing Administration. Yet despite the need for reliable information about what this program costs, Congress has actually prevented the nonpartisan Congressional Budget Office from doing just that. As a result, we have the highly unusual situation of the Congress asking CBO to provide it with the best estimate of what the budget agency believes the program costs, while dictating what information the CBO must use to construct its estimate. In the early 1990s, Congress made important changes to the way federal loan programs are treated in the budget with the enactment of the Federal Credit Reform Act, or FCRA. That law put federal loan programs on an accrual basis and was a big improvement over measuring loans on a cash-in, cash-out basis. But what lawmakers also included was a provision in the law that systematically understates the cost of government loan programs. And I'm using the words of the Congressional Budget Office there. They mandated that budget analysts, including the CBO, discount risky cash flows associated with a loan at a risk-free rate, the interest rates on U.S. Treasury securities. Thus, the average expected cash flows for government loans are treated as if they were financially indistinguishable from those of a U.S. Treasury with the same expected performance. The CBO has argued that that approach does not provide a comprehensive measure of what federal credit programs actually cost the government. Indeed, FCRA suggests that the government can earn a profit on student loans, even though it provides them at terms much more generous than taxpayers would offer voluntarily. FCRA's risk-free discounting can also make it appear, albeit erroneously, that when the government purchases loans at market prices, it immediately records a financial gain. Worse still, the riskier the loan that the government buys, the larger the immediate financial gain. The Center on Budget and Policy Priorities warned in 2005 that those dubious results created a, quote, supposed free lunch, unquote, and in response argued fervently that expected returns on risky assets must be risk-adjusted, citing the CBO and many economists. But as I am sure you will hear today, the CBPP now says that view was, quote, mistaken. The economists that the CBPP cited in 2005, including the CBO, have not, however, changed their position. A better accounting approach, one endorsed by the Congressional Budget Office and many financial economists, would discount loan cash flows using a market-based rate, one that is higher than a U.S. Treasury rate. That approach incorporates a cost for bearing market risk, also called fair value accounting. So at first glance, this support for fair value accounting would suggest that Congress should amend FCRA and require that budget estimates for loan programs use a market-based discount rate. But I would recommend a different approach. Requiring that cost estimates use a specific type of discount rate, a U.S. Treasury rate or a market-based rate for that matter, is a highly unusual intrusion on the discretion Congress affords the CBO. When the CBO develops estimates for other federal programs like the Pell Grant program, Congress does not require it to assume a certain rate of inflation or student enrollment growth. The CBO uses whatever it believes is most appropriate. In that regard, Congress should simply amend the language of FCRA to give budget agencies the freedom to use the discount rate they deem will result in the best estimate. This will surely result in fair value accounting because the CBO already supports that. And that is a great result because it will be an accounting decision that is free of congressional and partisan interference. That concludes my testimony today. I look forward to questions that you may have.
Thank you, sir. Mr. Elliott.
Thank you, Senator. And thank you all for the opportunity to testify today on an area of great interest to me. Senator Lee was kind enough to describe my background with this. I founded the Center on Federal Financial Institutions and worked at it as a volunteer for 3 years because I do believe this is a very important and underlooked area. And he was kind enough to mention my book as well. Given the political nature of so much of the discussion, let me note that I am as close to a political neutral as you will find on this topic. I do not belong to a political party. I have served in no administration, and I'm a moderate on the political spectrum. So you can factor that in as you listen to me. In my book, I made a number of recommendations for improving the effectiveness and efficiency of the federal credit program. I would like to repeat a few of them here. Specifically, we should target borrowers more carefully, take more account of the relative risks of different loans, use the same budget rules for all federal credit programs, use risk-based discount rates for federal budget purposes, formalize the process of initiating new federal credit programs, create a federal bank to administer all these programs, focus more on optimizing the allocation of money between these various programs, spread best practices across the programs more effectively, and improve the compensation and training of federal financial workers. Now, given your interests and the time constraints, I'll focus on risk-based discount rates. Accounting systems such as the federal budget are tools that should be designed to meet specific needs and should differ depending on those needs. There's not a right moral answer. These are tools. Our current budget approach for federal credit programs ignores the variability of potential results. Given how strongly the budget numbers drive decision-making, we are effectively acting as if Congress and the taxpayers do not care about risk, which I do not believe to be the case. Instead, I believe subsidy costs in the federal budget should reflect this uncertainty for several reasons, which mostly come down to how they are likely to change the decision-making. First, it is important that federal credit programs be structured to minimize risk where possible while still achieving the overall objectives. This is less likely to happen when the budget numbers that drive them ignore risk. Second, the benefit to borrowers of government loans is higher for risky loans, since these would be priced higher by private lenders but are not usually priced higher by the government. Ignoring that risk for federal budgeting has distorting effects on the choices that members of Congress make. In particular, there will be a tendency to direct scarce federal dollars to sectors where there is more uncertainty in the outcomes, since those borrowers will find the federal loans more valuable. They will lobby harder for them, and they're more likely to apply for and to accept such loans, choosing them over private alternatives. Third, risk-based pricing, one of my other recommendations, is considerably more likely to be implemented if the budget appropriately reflects risk as a cost. The situation today in which a loan with a wide range of potential outcomes is treated as costing the same as a relatively certain loan discourages political decisions that take account of such risk. Now, there are reasonable counterarguments to moving to risk-based discount rates, although I do not personally find them compelling. The principal one is that the U.S. government can spread any unexpected losses over a very wide tax base and many years of time, and therefore does not need to worry about the variability of outcomes. However, the way in which federal credit losses are ultimately offset is by increasing taxes or decreasing federal expenditures. And it seems very likely that taxpayers would prefer less risk of a big tax increase to more risk of one, even if the latter were offset by a potential on the other side for unusually good performance and future tax reductions. This is especially likely since, as Douglas referred to, credit losses are concentrated in those years when the economy is particularly bad, and taxpayers are unlikely to feel capable of comfortably bearing the resulting tax increases. There are also various technical arguments about maintaining the consistency of federal credit programs with other programs and of dealing with swings in estimated costs. These are reasonable concerns, but they are outweighed by the fact that Congress uses the initial subsidy estimates as by far the most important figure on which to make decisions. As long as these are the critical numbers, I believe it is important to incorporate risk appropriately into them in order to improve the quality of decisions. Thank you very much for your time and consideration.
Thank you, Mr. Elliott. Mr. Vanderwater.
Senator Lee, Ranking Member Maloney, members of the committee, thank you for the opportunity to appear here today. The current method of accounting for federal credit programs, as you've heard, fully records on a present value basis all of the cash flows into and out of the Treasury, and that fully reflects the risk of default. In contrast, fair value accounting would add an extra amount to the budgetary cost based on the fact that loan assets are less valuable to the private sector than to the government for several reasons. Businesses must make a profit. They can't put themselves at the head of the line when collecting a debt. They borrow at higher interest rates than the government. And private sector investors are risk averse. That is, they dislike losses, in this case, higher than expected loan defaults, more than they like equal and as equally likely gains, lower defaults. But none of those factors that affect private sector lenders represent an actual cost that the government incurs when it makes loans. For that reason, I think fair value accounting is misguided for 4 reasons. First of all, the budget should reflect only the federal government's actual income and outgo. That is, funds that the Treasury actually receives or disperses, including in the budget a cost for risk that the government does not actually pay, would overstate spending, deficits, and debt, making the federal budget a less accurate depiction of the nation's fiscal position. Second, fair value accounting would treat different federal programs inconsistently because it would not impose a risk aversion penalty on non-credit programs, many of which have costs that are at least as uncertain and variable as those of credit programs. Regardless of one's position on whether a particular credit program is worthwhile or not, the budget should put credit programs and other programs on a level playing field. Fair value accounting would tilt the playing field against credit programs, thereby distorting the process of setting priorities. Third, even if one thought that the federal government should be risk-averse on behalf of its citizens, as advocates contend, fair value accounting presents an incomplete and misleading picture of federal credit programs. Federal loan programs do not necessarily increase financial risk for U.S. citizens overall. If the cost of a loan program turns out to be higher than originally estimated, taxpayers will indeed eventually have to cover the higher costs. But students, farmers, homeowners, or other borrowers will have received more help. Fair value accounting considers only the first half of this equation. Fourth and finally, cost estimates by themselves are not designed to assess whether a federal program is worthwhile, and they should not be expected to do so. Deciding whether a federal program or project is worth undertaking or expanding entails evaluating many factors in addition to its cost for the government, and risk is indeed one of those. Doug Elliott suggests that leaving risk out of a cost estimate suggests that the government doesn't care about risk. Well, I would have to disagree with my friend Doug on that topic. There are a lot of things that get left out of cost estimates that are extremely important. As an example, building a bridge from in a lightly populated area is probably likely to be less valuable and may not be worth doing compared to resurfacing a heavily traveled highway in the Northeast Corridor. A bill's cost estimate is never going to affect all of these different factors, and trying to do so is a vain effort. My conclusion is the same as that of former CBO Director Robert Reischauer, who says that fair value accounting, quote, represents a misguided attempt to mold budget accounting to facilitate a cost-benefit analysis, with the result that neither the budget nor the cost-benefit analysis would serve their intended purpose well. Thank you.
Thank you very much. Thanks to each of you for your testimony. It seems to me that if we're using accounting methods that don't accurately reflect reality, then the fundamental problem here is that we're lying to ourselves. We're fooling ourselves, and we're fooling ourselves with regard to a very large sum of money. So, Dr. Holtz-Eakin, are we making these decisions under flawed accounting rules without a good idea of the relevant trade-offs? That is, if we're analyzing these incorrectly, do we really have the ability accurately to ascertain whether some other program or no action at all might be preferable?
I don't believe so. I think that fair value accounting would affect a lot of different aspects of the operation of the government. It would affect the analysis of new programs. It would affect the re-estimates that occur each year. It would affect the balance sheet presentation. But the most important thing it would affect would be the decision-making by the Congress about the relative costs of programs. The Congress has the right to determine the value of programs. That's what it does. But it should be presented with an accurate measure of the costs so that they can make good decisions, and they're not right now.
And if we're not doing that, then we're fooling ourselves. We're not getting accurate information, or when we present information saying this is worth it, this is making money, when in fact it's not, we're not making logical decisions.
I think the most important point that Dr. Delisle made was that the Congress has precluded the CBO or anyone else from giving a fair representation of the expected cost of the programs. That's not in your interest.
And Mr. Delisle, we're not really talking here about changing programs. We're talking about analyzing them accurately. Is that correct?
Right. So we're talking about the cost, and usually in these debates we hear a lot about the benefits of the programs. Fair value is completely agnostic to the benefits of the program. You can have a government program that costs money and provides benefits to people. I think that, in fact, that's actually quite intuitive. It's credit reform that flips that upside down and suggests that you can provide benefits to people and also earn a net return, which doesn't really make much sense.
Yeah, and I'd ask both of you, what are the risks to the taxpayer when we pretend that programs raise money for the government while the CBO finds that they lose money under fair value? What kind of risk does that present?
There are hypothetical answers to that, but I'll give you a real one. We did an estimate of the taxpayer cost of the implicit subsidy and guarantee to Fannie Mae and Freddie Mac. We did it back in 2003 or 4 when I was CBO director. That number was about $20 billion a year, or $200 billion. It was painfully close to what the taxpayer ultimately had to shell out in the crisis for the housing GSEs. That's the risk you run. You will not budget for real costs that will happen at very bad moments.
Well, I would, the flaws in the Federal Credit Reform Act actually make the entire world of finance appear as a gigantic arbitrage opportunity for the federal government. To show you how distorting that is, you've heard that Greece has a bit of a debt problem, and the market is charging them quite a high interest rate on their bonds. Under FCRA, if the federal government purchased Greece's debt, it would book an immediate profit. I can't imagine many members of the committee suggesting that that looks right to them.
Maybe we should look into that, though. Mr. Elliott, on the net, examining all federal programs in the aggregate and all costs and benefits of these programs, does the academic literature indicate that during normal economic times, the federal credit programs are net negative or a net positive for the economy?
We don't know is the short answer. One reason we don't know is there are many judgment calls that have to be made. I think there are certain programs, student loan programs, for example, where it's very clear that there's a market imperfection that really can't be solved other than by having a very significant federal role. Programs like that, there's no question in my mind that at least properly run provide a significant economic benefit. Many of the other programs, it's harder to say. In many ways, they're more redistributional than anything else. It's choosing which segments of the population to help, and Congress may have valid reasons for helping them, or they may not.
Thank you. Okay, I see my time's expired. Ranking Member Maloney.
Thank you. Mr. Vandewater, changing to fair value budgeting would have far-reaching consequences for students and veterans, home buyers, and small businesses who benefit from our various federal credit programs. Fair value budgeting would not actually make federal credit programs more costly, but it would certainly make them all appear more costly than they really are. They would do this by assuming banks and governments are somehow alike and assigning to government credit programs the same costs of lending as those faced in the private sector. So would increased phantom costs resulting from fair value accounting be passed along to borrowers in the form of higher interest rates and fees?
We can only speculate as to what the result would be, but certainly by increasing the cost of credit programs relative to those of non-credit programs, it would change the incentives, exactly as Doug Elliott has just said, in a way that would make it highly likely that Congress would either reduce the scope of the lending programs or change the terms, that is, increase the interest rates, charge higher origination fees, whatever, in ways as to make the programs less generous. So I think it is clear that changing the accounting method would be likely to have real impacts on borrowers.
Yeah, and as the cost of these federal credit programs appear to increase, would the federal deficit also increase?
Well, that's one of the complications that this introduces. The problem, as I see it with fair value accounting, is that it introduces a cost in the budget which is not actually a cash dollar cost that the government ever incurs. The good thing about our current accounting system is that we actually have a benchmark at the end of the day for figuring out whether things actually worked out the way we estimated. Namely, we can observe the cash flows. But if one starts adding a cost, in this case a cost for risk, which is not a cash cost, we lose that ability to track the budget to what actually happens. The proposals for fair value accounting make various, depending on the proposal, make various adjustments to make sure the books balance in the end, even when you've added this imaginary cost.
And would higher apparent costs for federal credit programs disadvantage them relative to other federal programs, and if so, how?
That's exactly right. As the other witnesses have indicated, the essence of fair value accounting is to add to the cost of estimated cost of federal credit programs an additional item, a risk premium, a risk penalty, to reflect the fact that there is an uncertainty in the what the disbursements of the credit programs will actually be. But the same thing is true for many, many other federal spending programs as well. In advance, we don't know exactly what they're going to cost, and we don't know precisely in what years they'll be incurred. So by adding a risk penalty for credit programs, but not for other federal programs, we're thereby putting the credit programs at a disadvantage.
Thank you. Mr. Delisle, there are more than 20 million college students now in the United States, and many of them rely on student loans provided by or guaranteed by the federal government. Fair value accounting would likely mean that student loan programs will shrink and/or that interest rates will go up. How would you defend fair value accounting to a large meeting of college students?
Well, I would say, like I said at the beginning of my testimony, there's a strong rationale for having a federal student loan program, and it's important to provide subsidized credit to them. I'm 100% for that. But what the program costs should be agnostic to what we think the benefits are, right? Cost-benefit analysis is two parts. You got to get the costs right, you got to get the benefits right. They're two different things.
And Mr. Elliott, we have received, I went through a whole stack of letters from organizations, stakeholders in our country that were basically opposing the fair value accounting. To name a few, the National Education Association, the National Association of Home Builders, the Retired Enlisted Association, the National Rural Electric Cooperative Association, the Student Aid Alliance, many other very active association, including the National Association of Realtors, have gone on record against fair value. And if you were advising a member of Congress on this issue, how would you recommend that he or she explain the issue to these organizations as they are opposed to it and feel?
I think I would argue along the same lines that Jason just did, which is essentially we want Congress to be making decisions based on the best possible cost numbers, best possible benefit numbers. I'm not at all surprised that a set of borrowers basically would prefer us to use lower discount rates on the theory that won't give us any incentive to increase the rates. So there's nothing we can say to them which will change their position.
Well, my time has expired.
Okay, next we'll recognize Mr. Delaney, then after Mr. Delaney, Mr. Schweikert, and we'll proceed from there.
Thank you. I want to thank all the witnesses for being here today and sharing their testimony. Mr. Elliott, you mentioned a concept that I thought was very interesting, which is creating a bank within the government and consolidating all the lending activities out of that bank, which I'd love to follow up with you more on that. That seems to be a pretty interesting idea. You could have consolidated accounting and credit and portfolio management and all those kind of things. And it would make these programs inherently less sloppy, right, because there'd be more rigor around how they're managed. From an accounting standpoint, if that bank had its assets effectively marked to market, which is in some ways what this does, would you suggest that its liabilities also be marked to market? Because my experience with financial institutions, if you mark one side of the balance sheet, you have to mark the other side as well. How should we think about a lot of discussions about marking the assets to market to provide greater transparency as to are they priced right, how do they compare to the market, et cetera? Would we then also have to mark the liabilities to market?
So two parts. First, thank you for your positive comments about the idea of a single federal credit bank. I do think there are there's great potential there for improved efficiency, which is
Yeah,
in every.
and we'll follow up on that later, yeah.
In terms of the question, what the Federal Credit Reform Act does is it looks at both the positive and negative cash flows out from this point in time forward. All those flows, whether positive or negative at any point, are discounted back at the same discount rate.
Right.
So your question then would have to be, to get to what you're calling the liability side, is we'd have to decide how were we funding those?
Yes.
Which we don't do in the budget. We don't say this part's from borrowing, that's from a 3-year borrowing, that's from a 7-year borrowing. This part.
But you could, right? If you ran it as a bank, you could basically have a relationship with the Treasury Department and issue different series of notes to the Treasury that they would buy, and you'd have a whole liability stack.
Yeah, you know, it's an interesting point and not one I've seriously considered, to be honest, because it's so far different from how we budget now. I've just not given it thought.
Because I just think when we talk about mark-to-market accounting, which is basically where we're going in this discussion, it's like people talk about that with banks all the time. You know, they say that banks should mark their assets to market, which most banks don't mark their loans to market. Mm-hmm. But in reality, they then should mark their liabilities to market, right? And banks have much better liabilities than non-banks do. So those liabilities would mark up, and you'd mark the assets down, and you'd kind of end up in the same place. So I think it's important, if we think about mark-to-market accounting for the assets, that we also have some framework for thinking about it for the liabilities, so that you don't overcorrect so much. Because, in fact, the government borrows at much better rates than your average AAA borrower. And so, in fact, the government's liabilities are worth more, right? So just when you would mark these assets down, you'd be marking the liabilities up. But I think there might be a better way to get at some of the issues that I agree with you on, as to whether we're pricing these things right, whether we really understand the cost. And Mr. Holtz-Eakin or Dr. Holtz-Eakin, maybe you could comment on this. I've talked about a proposal where, rather than changing the accounting, we simply require the government on a regular basis to sell off 10% of all its exposure in all these credit programs, right? So you take all the credit programs, XM, housing programs, things we do for small businesses, go down the list and say, on some regular basis, you have to sell off 10% of your exposure to the market. And then we see how the market prices it. Right, and that to me, because using accounting to figure out if things are priced right is theoretical, and it's based on assumptions, and people can always play with assumptions. But when you actually have to sell a piece to the market, you're actually getting real transparency, and that information in some programs should maybe dictate how they're priced, but other programs we just should know it. We should say, hey, we're making loans to startup energy companies that would sell for 20 cents on the dollar. That's a huge subsidy. Should we be using that money elsewhere? Would you comment on that proposal?
So I think that's quite useful. In terms of the two things that are going to be affected, the first is, as you mentioned, the mark-to-market on the balance sheet. I'm actually less concerned about that, and much more concerned about the income statement, making sure we get the costs right.
Yep.
One of the practical difficulties people always ask is, how do I get the right market risk to do the discounting?
If you sell a piece, you know.
This gives you some information,
right?
And I think it's something that's worth exploring.
I've talked to the chairman of the Financial Services Committee, the House Chairman Hensling, about this, because there's a big debate with XM right now. Folks at XM say they priced in the market.
Right.
All these other people come in and say they're undercutting the market. My point is, well, we should just make them sell off part of their balance sheet every year, and then we'll know. Right? If people pay par, they're pricing it right. If they pay at a big discount, then there's a big subsidy, and then we can decide, are we okay with that?
Right, and you'd want to get a maturity strip so that you
Right.
can get the re-estimates right.
You'd have to do it in a logical way, but so that's something that I also think should be put on the table in this discussion as you all think about this. Thank you.
Okay, we're now going to go to Senator Klobuchar and then to Mr. Schweikert.
Thank you, Congressman. I appreciate it. Thank you to all our witnesses. It's great to see some of you back, Dr. Holtz-Eakin, and to be back here at the Joint Economic Committee on this important hearing. I thought I'd start out with veterans housing. Since 2001, the VA has helped 3.75 million veterans buy their own homes. Mr. Vanderwater, how would changing to the fair value or added cost accounting method affect the VA's home loan program, in your view?
Senator, the general effect of fair value accounting is to increase the estimated cost of credit programs compared to the way that cost is recorded under the under the current accounting mechanism. And while we can't be sure exactly how Congress would respond to that change with regard to any particular program, including veterans, I think it's highly likely that if the program were to appear more expensive, that it would fare less well in the annual competition for resources, and therefore, again, it's likely, although not entirely certain, that the veterans housing programs would become smaller, or that the loan terms would be changed in a way to reduce the subsidies for borrowers.
Okay, thank you. Mr. Elliott, Minnesota cares a lot about infrastructure. We're the state that had that bridge collapse 6 blocks from my house, killing 13 people. And as you know, we have some issues with infrastructure and for everything from bridges, roads, rail. And I'm a fan of doing something about it, and I support a lot of the work that Congressman Delaney has been doing and others in this area. How would switching from the current financing system using the 30-year Treasury rate and a credit premium to the fair value or added cost accounting affect investment in infrastructure, in your view? Are there other funding mechanisms that we should examine?
Well, currently, in my view, we understate the cost of all the programs, and therefore, Congress would be looking at higher costs to do the same thing using the current approach. As with Paul, I can't say what Congress might then choose to do in terms of that. Presumably, higher costs might make them do less, but who knows? In terms of other ways of doing it, there are, of course, things like public-private partnerships, but I honestly will confess I'm not an expert on those.
That's Mr. Delaney.
No.
You can ask him. No, there's a lot of, Senator Warner, actually, we're putting our bill out today, a bipartisan bill, similar to some of the work that Congressman Delaney has done. And so that is part of the answer, but clearly not the only answer. I just wanted to end on the Exim Bank. We have 170 Minnesota businesses that have been helped by the Exim Bank just in 1 year alone. And I visit all 87 counties in my state every year, and I often visit these small businesses. The topic usually isn't even Exim, but then I find out that they are exporting. We're such a big export state. We have 17 Fortune 500 companies, and it spawned a lot of smaller companies that do exporting, but they literally have no expert on Kazakhstan or something, and they use the Exim Bank to help them and help them with financing. Mr. Vanderwater, does the current system under the Fair Credit Reporting Act of 1990 reflect the costs of the Exim Bank to the taxpayers, and how would the funds returned to the American taxpayer be accounted for under the new rules?
Yes, Senator. The current accounting mechanism fully reflects all of the cash that goes into or out of the Treasury, so that in that sense, the current accounting mechanism does reflect the full cost of the Export-Import Bank and other credit programs. The difference is that fair value accounting would add to that cost, to the recorded cost, an additional sum to reflect risk, which is not an actual cash cost to the Treasury or to taxpayers.
Okay. Anyone want to add anything? or disagree?
If I could
Okay.
just add one thing briefly. One of the issues we sometimes lose sight of is both potential approaches are simply ways of trying to summarize a long series of future cash outflows and inflows. The human mind isn't capable of dealing with it. If we were to tell you it's X amount this year, X amount this year, you couldn't usefully do that. So we have to bring it to a value in today's dollars. These are both reasonable ways of doing it. What we're arguing about is what would be the effects of doing it one way or another in terms of how you would make your decisions.
Right. Okay. Well, I'll just make one last shameless pitch for the Exim Bank, which is not the subject of this hearing, but as been pointed out, it could be affected by the way we do accounting, may affect taxpayers and those involved. And that is that we have 80 developed nations that across the world that have similar financing authorities, and we would be the only one that didn't. We have China having major financing opportunities for their businesses, and I just hope we find a way in the next few weeks that not to shut the Exim Bank down. You're nodding your head, Dr. Holtz-Eakin. Do you agree with me?
Yeah, perhaps to the chagrin of my fellow conservatives, I'm uncompelled by a theoretical argument that it shouldn't exist. I mean, I think if you look at the data, you can make the case that Exim should be reformed in some fairly dramatic ways, that its exposure cap might actually be restricted until we saw the moment where actual exporters couldn't get financing, and then we'd know we'd need it. But I don't see how you can decide in the absence of that evidence that it shouldn't be around.
Very good. That's a perfect end to my questions. Thank you, everyone.
Okay, Congressman Schweikert, and then we'll go to Congressman Beyer.
Thank you, Senator Lee. First off, Mr. Delaney, thank you. That's actually a creative idea. You know, part of the discussion here for many of us who are sort of fixated on sort of price theory is what's the actual pricing, the value of both the credit risk, the programmatic risk, and how do you discover that? To the Democrat witness, all those years in those finance classes, I need to go back and get my money back from those professors because I've now heard things I've never heard before. One of my personal fixations here, Mr. Chairman and Dr. Holtz-Eakin, I'd love, because I think you've actually written parts about this, is what's the actual value of credit programs, and how do you actually value the risk profile of them? Because we seem to have a setup today with the massive amounts of, most Americans have no concept the amount the federal government is on the hook for. I mean, what was it, the article, Politico article last year or several months ago, the real Bank of America, it was in the trillions and trillions and trillions and trillions and trillions of dollars they were in the hook for. You would do more than just the fair value accounting. Wouldn't you ultimately try to develop a risk pricing model for these programs? How would you go about doing that?
So a couple of things. First, I'd echo what my friend Mr. Delisle says again and again, which is be very clear about what is a cost and what is a benefit. And so when you say what is the value of a credit program, that sounds like the benefit to those who are served by it. There may be some empirical evidence, but that's also a judgment call on the end of the policymakers. If you're going to measure costs, step number 2 is to, first of all, quantify all the costs that are actually present in the economic environment. And in this instance, for credit programs, it's out there in markets. We can find out. We can do price discovery the way Mr. Delaney suggests, or use other techniques. But take a full comprehensive measure. Let me finish one more thing, because this is the important point. And then the point that Mr. Vanderwater made earlier was, look, other programs have costs as well. So Security has some risk, Medicare has some risk. We're not quantifying that. That actually makes the major point, which is you can't pretend the federal government is a riskless entity. All it does is transmit the risks in the economic environment through it back to the taxpayers who are subject to those risks to begin with. So measure them comprehensively, trace them back to the taxpayer, because that's ultimately who's going to pay.
You may have actually nailed that. Forgive me if I mispronounced. Is it Delisle?
Delisle.
Delisle. I wouldn't have even got close.
That's all right.
All right. So a bifurcation of this argument, because in some ways I almost am hearing that I don't want to know the real pricing because it may take away my policy optionality over here because we might not do this. How do I mentally get my fellow members of Congress to sort of bifurcate this, saying we need to know the real cost of what we're doing, and then on this side deal with the policy side of it? Because when many of us start to really dig into the unfunded liabilities, it's stunning. We're seeing some in academia saying we're well over a couple $100 trillion in the 75-year window of unfunded liabilities. Yet, if you were to share that with fellow members of Congress, they would just stare at you. How do we do that education?
Sorry, you do it exactly the same way you do it for every other federal program, which is you say to the nonpartisan Congressional Budget Office, do your best. Tell me what you think it costs, but don't tell me what you think we should do after you've given us that information. We'll handle that. Loans are different because it is the only place that I know of where Congress has told the CBO to use a set of assumptions in its estimate. So the CBO can't do that. And that's why we're here today. If there were no provision requiring the CBO to use a certain kind of discount rate in its estimate, we wouldn't be here.
So, Dr.
If I could add something, there is another big difference between these credit programs and those other, quote, unfunded liabilities. Credit programs are a contract. I mean, you have to honor it. Once that loan is issued, that's a loan contract, and the taxpayer's on the hook. The so-called, quote, unfunded liabilities are not liabilities. They're programmatic decisions made by Congress and can be changed. That there's settled law on that fact. And the term unfunded I dislike intensely because it suggests the only need is to fund them, and there isn't enough taxes out there to do that.
Well,
so this is about the decision-making for the structure of those
simple
programs.
Reality, I've been here 5 years, and I think I've never been able to have a rational vote on mandatory spending. And in 4 years, 76% of all of our spending will be programmatic. So it is the clash of math and policy, and it's collapsing very fast around us. With that, Mr. Chairman, yield back.
Mr. Breyer.
Thank you, Senator. Mr. Elliott, if the current FCRA regulation takes the present value of the long-term cash flow out and the long-term cash flow in, doesn't this already reflect the likelihood of default of some of these loans? And doesn't this methodology then already build the risk into the portfolio? On top of that, how do you answer the objection that over the past 2 decades, FCRA has proven to be extremely accurate in projecting the actual cash flow of all these federal credit loan programs?
There's a confusion with the term risk. If you mean risk, the potential for losing, the expectation of losing money, that is, some loans won't pay you back, FCRA does a good job of taking that into account. What we are talking about here is when you enter into a program, some of them, there's a high likelihood you'll end up where you expect to be, and there are other programs with a much wider range of possibilities. And so the question is, do you, as a member of Congress, want a budget number to reflect the difference between very certain results and very uncertain results, or do you not?
It seems to me that one of the issues here is that we're trying to compare the federal government's credit to that of a major financial institution, a bank, a profit-making institution. And clearly, we are involved in this as a federal government because we're making loans that banks wouldn't make, student loans being the best example. So, and we're doing that because we have a larger social purpose. So, Dr. Vandewater sort of reminds me of the asymmetric warfare, that fair value takes societal costs but not societal benefits. It's like the dynamic scoring, which my dear friend Congressman Delaney has written about very well in various op-eds in the Post, that dynamic scoring takes in all the benefits of a tax cut, but absolutely none of the benefits of investing in education and health care and housing and the like. I got an email from the University of Virginia that asked, would a move to fair value accounting capture both the values of pursuing higher education and the monetary and non-monetary positive externalities of
having a highly educated populace that has access to federal student loans?
Well, the answer to that is, of course, not. And we wouldn't expect that a federal budget cost estimate would include things like that, because many of those things are benefits to the individual students. They're extremely important benefits. Some of them have carryover benefits for the economy as a whole. But that's a perfect example that just because there are other costs and benefits, there are a lot of costs and benefits that are never going to show up in a cost estimate that are essential for the Congress to evaluate in deciding whether to go ahead with a program or to expand it. But for accounting, I've been arguing that we should retain as a benchmark cash actually going into and out of the government. And you should not expect a cost estimate to contain anything beyond that.
And my suggestion is when you have risk things that can't be assessed down the line, that can be also offset by the societal benefits that we're also choosing not to measure.
Exactly, because while a loan program, the student loan program, for example, does in fact increase for risks for taxpayers, it's reducing the risks for the student borrowers. And at the same time as, if the estimates of default turn out to be higher than expected, it means, as I said in my testimony, that taxpayers will be bearing a higher cost, but it also means that the student borrowers will be receiving a higher benefit. Those are both very important facts, but neither one of them belongs in the cost estimate, in my view.
Thank you. Mr. Delisle, one slightly tongue-in-cheek question, which is why would we ever buy Greek debt? And then the more serious one is, given that we don't have a profit motive as the government in our federal credit, and the market risk premium represents an opportunity cost that is not tied to cash flow. Doesn't the cash flow make much more sense than an opportunity cost that may never be realized? Especially when the historical data suggests that, in fact, we're doing just fine.
Do you believe that the average expected cash flow, as CBO estimates it from a student loan, is guaranteed to occur exactly the way they project it to occur? If so, FCRA is your model. If you don't think average expected cash flows are guaranteed to occur the way they are estimated, then fair value is your model. In terms of why would we ever buy Greek debt, FCRA tells you there's absolutely no budget reason not to do so.
Except that we have the larger social purposes. We've put these things in place because we're trying to build a better America, a better economy. I'm not sure that buying Greek debt's on that list.
But it doesn't cost you anything. FCRA says you make money doing it immediately. So why wouldn't you do it if you make money and you help out, you solve a financial crisis? There's no budgetary reason not to do it. But I'm very delighted that you are having problems with the notion that there's no budget reason not to do that. But I should say on the issue of measuring the benefits, you're holding fair value accounting to a higher standard than all the other ways we do cost estimates. None of them, not cash accounting, not FCRA, none of them factor in the benefits. When you do the estimate for a highway project, it doesn't include the value of the benefits. Sure. None of the approaches do. So this isn't a flaw with fair value. You're simply asking more of fair value than you're asking of any of the other accounting methods.
Okay, thank you. Mr. Chairman, thank you.
Senator Cotton.
Thank you. I apologize if we've been over this ground. I'm just coming from presiding over the Senate. I'd like to start, Dr. Holtz-Eakin, with you. Could you outline any real challenges or risks to simply using fair value accounting as one source of knowledge, even if it's not mandated for use, even if it's not something that we put in statute, but it's something that informs our policy judgments?
I see no downside to that. Indeed, some of that happens now. We've seen the CBO put out estimates of the budgetary impact of various credit programs under both FCRA accounting and what they would look like under fair value so that Congress has some notion, the Ex-Im Bank being a notable example.
Okay. I'll tell you what, why don't we just go down the panel and hear responses to that?
I'm sorry, the question again was?
So is there any risk or drawback of using fair value accounting as at least one source of information to inform policy judgments, even if we don't amend FCRA and make that the method of accounting?
Well, I think that the risks in using fair value are the same they are in using other accounting methods, that the information you know today ends up not being perfect, and so something changes in the future to make your original estimate different or off. Those exist in all the forms. I should point out, though, that there has been some conversation about how the federal government is different from private entities. I think that that is a perfectly valid argument if the federal government had its own money. It doesn't have its own money. It has our money, and it has to use our value for the price of risk. That's only fair. And where do we go to assess our collective value for risk? We look at market prices, because you have a massive voting system on what something is worth, and I think that's the appropriate place to go to figure out what these loans actually cost.
Could I ask you to say more about the conversation you cited about the differences between the federal government and businesses? I hear that, and I hear, and my thinking is, yes, the federal government is different. It's not a for-profit enterprise. Therefore, it makes decisions not based on market or financial signals, but on political decisions, oftentimes and frequently, whereas market-based institutions pick winners and losers. That's in the nature of a capitalist society. The government tends to pick losers because if they were winners, they would have gotten financing in the private marketplace. So you could say a little bit more about that?
So my first response is nonprofit credit unions are nonprofit. They also can borrow at a very low rate because they have a government guarantee on their deposits. Even they don't make loans at terms as generous as the federal government because they don't think it's worth it. So there's clearly something more going on than your profit motive. I also think that the same could be true for pension funds, right? Pension funds are nonprofit, but they assign a value to assets at the market price, and I think that's the fairest value, regardless of your intentions and your motivations.
Okay, Mr. Elliott, any real risk of at least using fair value accounting as a way to inform our decision making?
I think it would be a step forward very clearly. The one risk is there is an argument that having two sets of numbers makes it a little harder for people to, there's a danger of talking past each other, but I'd still rather have the extra information.
Okay.
I see no objection to providing additional information of that sort.
So it sounds like we're all in agreement. It's worthwhile and should inform our policy making. Okay. Thank you all. Thank you.
I want to thank our committee members, and I want to thank our witnesses, especially for coming and providing insightful testimony. Your testimony has been very helpful. The hearing record will remain open for 3 business days for those members who may wish to submit questions for the record. We'll be adjourned.